Good afternoon, everybody, and welcome to our webinar this afternoon. My name is Alan Errett. I head up retail distribution at STANLIB and have the pleasure of hosting all of you this afternoon. Just before we kick off, I just want to make reference to the recent STANLIB investment conference that we hosted, and I just want to once again thank all of you on the call who attended that conference just over 2 weeks ago. And thanks for all the feedback that you've sent through. Really encouraging to see some of the feedback kind of on our content, insights, and the information shared, relevant in terms of your conversations with your clients. And hopefully we can look to achieve that again today. And as I said to you 2 weeks ago, it's our commitment to yourselves that we will continue to look to ensure that for all client engagements like these, we share relevant information that you can engage and use in your conversations with your clients. So if I bring it to today's webinar, it's a pleasure for me to introduce our fixed income team. So we've got Mphaphuli, who's the head of our fixed income business at STANLIB, who joins me, and then Sylvester Kobo, who's our senior portfolio manager within our fixed income team, who's also with us this afternoon. Now, many of you on the call have got, probably all of you on the call have got clients invested in some way or other in our fixed income and our various unit trusts, which are managed by Victor, Sylvester, and the rest of the team. And obviously very important to keep you updated to be able to have conversations with your clients on these various portfolios. So Vic and Sly today are going to share some views on the outlooks on the markets, some key events and how those could potentially play out across fixed income markets. And then importantly, focus on two of our portfolios today to give you an update in terms of the positioning of those portfolios, taking into consideration the kind of market outlook and specifically going forward as well. So Vic will do the first part, and then Sly will touch on, obviously the income fund is a critical and important fund for ourselves, and many of you have got investors in there, and we are fully aware of the questions we've got, so we will kind of look to bring that into the presentation today as well. But I think importantly, we're in a different environment. If we go back 12 months ago, obviously compare this low interest rate and no yield environment, we're in a significantly different environment to 12 months ago, specifically with context to this call today. And importantly, yourselves on the call have a challenge to meet your clients' real return or positive real return requirements, as well as income requirements. So the income fund is definitely a fund that's suited to many of your clients. And importantly, the update that Sly will give you will kind of give that feedback to yourselves as well. But importantly, we're also going to profile our STANLIB Flexible Income Fund today. So our Flexible Income Fund is our multi-asset fixed interest solution, slightly more diversified than our kind of traditional income low risk solution, accessing other fixed income assets, including, for example, offshore bonds, listed property, preference shares, etc. So a solution which we feel is a potential solution that could be considered for clients who need to take on a little bit more risk, so slightly up the risk spectrum compared to the income fund, obviously, but looking to generate kind of obviously risk adjusted but positive real returns, and hopefully looking to meet your clients' income requirements. So before I hand over to Vic, that's just kind of like the overview of this afternoon's presentation, a little bit of housekeeping before we kick off. So we're aiming to be finished by 3 o'clock this afternoon. For those who want or looking for CBD points, please remember to stay registered throughout the call, so that at the end of the call, then we can obviously kind of register you for those points. We will be having a Q&A section as well at the end. So Vic and Sly will present probably till around 20 to 3, that's the plan. And then I'll facilitate a Q&A kind of session with Vic and Sly. So please send your questions through on the kind of Q&A kind of function on the webinar, and then I'll look to try and pose as many of those questions as possible at the end of today's session. So once again, thanks for joining us, and let me hand over to Vic. Thanks very much, Vic. Vic, you're on mute. Famous for...
Yeah. So, thank you very much for the wonderful introduction, Al. My name is Victor Mphaphuli. I head up the fixed income franchise at STANLIB. Today, I'm going to be doing the presentation with Sylvester Kobo, who is the senior portfolio manager within the franchise. For us, I mean, this is an opportunity that we evaluate a lot, given that there's a lot of volatility in the markets, and it does need, I mean, an opportunity for us to basically share our fixed income views. If you look at the first slide here, which is where I am showing some of the views, I mean, of where we think the world is basically going to be going, of which I'm also going to be giving an update, I mean, on the current movements in the market. As a franchise, our view is that the current volatility that you're seeing in the market, where we have seen global developed markets are moving higher, taking along emerging markets higher, and at the same time, I mean, creating a lot of volatility, not only for currencies, but also for fixed income strategies that you may be invested in. And the fact that this volatility happened, I mean, within a very short space of time, it can actually lead to a worry for investors as to whether they are invested in the correct strategies. So the view that we are going to postulate today is basically that even though we have seen some of this volatility playing out early in the year as a result of worries around inflation in the US, which could actually translate into inflation globally and then leading to this volatility. The market at current levels, I mean, is basically presenting value opportunities for investors that may be looking to come into fixed income products. And certainly, I mean, on our side, when we look at the budget speech that was presented by the Minister of Finance last month, we are much more constructive on South African debt matrices, which is going to be positive for the yield curve and also positive, I mean, for yields in general. So as a result, we're seeing this short-term sell-off that has come through as a result of the sell-off in the US as temporary. And I mean, we certainly believe that the Fed is not going to walk away from the markets like they have done, I mean, previously when markets become disorderly. We also think Jay Powell and together with the other governors of the Fed are actually going to come over time to calm the markets, because certainly, I mean, it wouldn't make sense, especially for a governor that is that has got 1 year to run in his current position. Why would he really want to leave markets, I mean, in a tailspin? So on our side, like last year when we did this presentation, there was a lot of turmoil. There was sell-off in bond yields, I mean, globally as a result of the COVID situation. This time, the cause for the sell-off is different. It's inflation. But I mean, we feel that the 9.5%, for example, on the 10-year South African benchmark bond is actually too high and present, I mean, a value opportunity. And we're sticking around with the 8.5%, I mean, that we presented last year, which we saw playing out, I mean, earlier this year. So as a result of the expected compression in yields, our expectation is that returns in the bond space from where we are currently to where we are expecting them to end could actually be as high as 16%. And if you take that and compare it with cash, which we expect to give you 4.5%, certainly, I mean, this presents an opportunity for investors to come into this portfolio. I've got a couple of slides that I'm going to use to back up this view before Sly comes in later on to present on the two products that I'll talk about. So if you look at this slide, because I think it's a very relevant slide, especially given the environment that we find ourselves in, where if you go back to 2013, where we had a sell-off in the market, but that sell-off was as a result of a Fed-generated taper tantrum. Look back then, the economic matrices were very similar to what we are having currently, and the Fed basically moved a little bit too quick, and as a result, I mean, they regretted it, I mean, later on, because inflation basically struggled to get up to the 2% targeted level. Back in 2013, unemployment was on average sitting at 7.5% when the Fed started talking about taper tantrum. The Fed's preferred measure of inflation, which is the PCE core inflation, was averaging 1.5%. And you look today, it's basically sitting at the same level as it was in 2013. The only difference now is that the sell-off that we're seeing in the markets is not generated by Fed activity. If anything, I mean, the Fed would prefer to remain accommodative for longer and basically use the lessons that they learned, I mean, in 2013 to not repeat the same mistakes, because in our minds, a central banker's biggest fear is to end up with a deflationary environment, especially now, I mean, where they're still been struggling to get to the 2% level. If you look at the blue line on top, that's the unemployment level in the US. The line moving higher, that's the decimation of the economy, people losing a lot of jobs, including livelihoods. But also at the same time, inflation, which is the line at the bottom, has remained below 2% for quite a long time. So in our view, I mean, the environment that we have currently is actually even worse than what we had in the taper tantrum. Of course, markets have taken it in their strides and basically trying to force the hand of the either come out and make some specific comments around what is it that they are exactly going to do. So we're not surprised that break-even inflation expectations, I mean, which is at the differential between nominal bonds and inflation-linked bonds in the US, have risen the way that that they have done. But of course, if you look at the graph on the right, which is basically whether the Fed in the past has been able to achieve the 2% inflation that they have talked about. What is clear for us, I mean, is that it's only temporal periods, I mean, that the Fed has been able to achieve that above 2% level. For most of the periods, I mean, since 1995, inflation or core PCE has struggled, I mean, below the targeted level of 2%. And that is basically explaining, I mean, how structurally low inflation in the US has become. And if you look at this graph, I mean, the purple line that you see rising there is break-evens that I've talked about earlier on. And then the blue line is the core PCE. And this line, I mean, they've actually struggled to get it up to 2%, as I mentioned earlier on. But you look at the break-evens, they've actually shot higher. There may be some inflation, maybe that comes through, maybe the blue line moves higher like we have seen, I mean, previously. But certainly in our view, the movements that you're gonna see in inflation, big as they may be in the short term, we think they are transitory in nature. And given the decimation that we have seen in the economy, the US inflation is basically going to repeat lower levels in future. I'm showing how markets have moved ahead of the Fed. The line, the dots that you're seeing by the Fed on where Fed fund rate are going to be 3 years out. But certainly, I mean, if you look at markets, they are basically because inflation is a problem. Of course, the markets also last week were disappointed, not by what Fed Chairman Powell said, but basically by what he didn't say, because I think the market was basically expecting him to come up with specific options or that the Fed has got in its toolbox. For example, whether he's going to be implementing yield curve control, which would result in additional quantitative easing. But also, I mean, we mustn't take it for granted that in the past, the Fed has been able to use other tools, including Operation Twist, where they would be selling shorter dated yields and buying longer dated yields. And then we saw, I mean, that huge compression in yields, I mean, back then, post the global relationship between the US and South Africa. The PT for this, for South Africa, having such a good budget, I mean, delivered by the minister, we didn't really get to see the benefits accrued, I mean, to the country in terms of lower borrowing costs. Basically, if you look at this graph, you know, it's showing But South Africa, in comparison to other emerging markets, it still stands out. I mean, as an attractive destination, attractiveness would yield results if markets globally start to calm. So if you go back to the taper tantrums, I mean, markets had weakened back then on the first few days by about 150 to 200 basis points. You look at markets, I mean, currently also weakening substantially without the Fed, I mean, having said anything. And in our view, we think, I mean, the Fed over time will come and try to take control of the narrative, which will help to contain any further significant weaknesses in the market. But also bearing in mind that some of the sell-off that you're seeing is already discounting this transitory inflation earlier on. So as a result, even our markets on the right-hand side are starting to discount that locally are probably going to rise, and in 9 to 12 months, probably even rise by 1%. We don't agree with this view. We think the markets are way toward rate hikes. We think, if anything, yes, we might start to see some rate of next year. And certainly, I mean, we expect the SAP to continue to run lower real short-term rates, which would be lower than the average 2% that they've run in the past, simply because, I mean, the economy has struggled immensely, and I mean, they'd like to get some. Bringing it back to the local markets, as I mentioned earlier on, by the minister, even though he didn't want to call it an austerity budget, for all intent budget, especially if you look at the areas where he's looking to make savings, which would include the big wage component. I mean, that comes through in our expenditure targets. And certainly, I mean, if you look at South Africa, which is where the CASA is compared to the average, I mean, for OECD countries, I mean, we stand out, you know. So in our minds, I mean, the minister is fairly justified to go this route. Of course, I mean, there's going to be some difficulties, as you would have seen, with unions coming to demand 4%. But if we look at some of the actions that the government has been following, I mean, previously, certainly, I mean, we think the minister really wants to make some delivery, you know, around this. And if he can deliver that, it will go a long way in helping the government to budget balance, I mean, which they want to get above 0% by 2024, 2025. So as a result of the improvements in revenue generation that have come through, which, by the way, the minister didn't go and waste, but is using some of that to repay, I mean, the debt, has actually led to a big improvement on the debt metrics. Previously, I mean, we were talking about that debt metrics basically getting to 100, but I mean, the last budget speech that he presented is basically showing that debt to GDP is going to top out at 88.9%. But of course, this doesn't mean that there are no risks, I mean, that could come through, which some of them are highlighted earlier on around the delivery on wages. But I mean, if you look at the way that, I mean, the minister is forecasting GDP in future, of which is not really building a huge increase, it does show that in order for him to achieve that, I mean, he has to negotiate quite hard, I mean, with the unions in order to that. And the markets, I mean, generally liked it post the budget speech. We saw a huge component on the yield curve. Like I said earlier on, some of those benefits basically out, and foreigners basically coming back to the market. So where I want to leave it before Sly comes in and go through the portfolios in favor of our fair value of 8.5%. The current 10-year benchmark is sitting at 9.5%. For the reasons that I gave earlier on, I mean, we think there's now, I mean, a lot of value that the markets are basically presenting, and the Fed is not going to sit benefit, I mean, from the huge amount of stimulus packages, that still sit in the system.
Thanks, Vic and Al. Good afternoon, everyone. So I've noted a few comments in the chat box about the poor sound quality. And if you don't mind, I'm going to put the camera off so that we can hopefully improve the bandwidth and we're able to lend the message that we are hoping to lend. As Al said, so in the portfolio update section, we are going to be focusing on the flexible income fund, but we are aware of the numerous questions or queries we've been getting on the income fund, so I will bring that in. But mainly on the flexible income fund, there will be 3 touch points or 3 main areas of focus. First being the current positioning and the outlook of other asset classes that the portfolio can invest in. And then finally, we'll look at the portfolio performance and risk. So the flexible income fund, it's as Al said, it's an income fund that allocates into other income generating asset classes like property and pref shares, and can also take offshore exposure. It is managed by a highly experienced team with years and years of asset allocation experience and benefits from a monthly fixed income tactical asset allocation process, which includes or involves the property team headed by Killen. Like all our other portfolios, this portfolio is actively managed consistently with our investment philosophy of not just taking long-term views and expressing those in the portfolio, sit idle until those are achieved, but rather also look for short-term market dislocations where we scour the markets for opportunities around that we can exploit to add value or additional alpha for our clients. So towards the end of 2019, we refined and enhanced our strategic and tactical asset allocation guidelines to help manage the risk in the portfolio, which is now mainly done through or largely done through diversification and minimizing correlations. So to draw your attention to that middle column there, that's where we show our SAA and TAA guidelines. And as you can see from our position in this portfolio is we actively diversified the portfolio and drawing your attention to the big active positions. So in nominal bonds, even though SAA guidelines 70%, we're currently underweight by about 12%. And this position has changed from the end of the year where we had about 89% allocation to nominal bonds. As Victor alluded to earlier, we saw a big rally at the beginning of the year where our fair value in bonds were achieved. So we then took some money off the table and rotated into other asset classes. Those asset classes being, we increased our offshore exposure to now close to 12%, made up of 8.5% global bond allocation and 3% global property. We parked some of the money in cash, which is the 20% there, but it's important to highlight that 15% of that 20% is sitting in the income fund. So it's an allocation into the income fund, which talks to a message that Vic was saying earlier, that our view at this level is cash is very expensive. So, and this graph illustrates that point, that whether be it deposit in the bank or sitting in money market funds, cash is currently expensive. And the blue line there shows that after that, those deep interest rate cuts last year, we saw cash rates now nearing inflation. And because of the low base of inflation and also the uptick in economic activity as lockdowns are relaxed, and also some administered prices like cost of electricity and petrol, we are expecting inflation to tick up later this year to around 5%, meaning at some point this year, cash is going to return below inflation, which is not an ideal situation. So then we choose to allocate up the curve into the income fund. We've shown this graph before, and I think it's important to maybe bring the message that, or rather to contextualize what's happening with the volatility that's in the market and how the income fund is behaving. So this graph shows the split, or rather it shows the total return of the income fund, being the purple line, over the past 3 years. And it is split into the capital portion, which is that low number there, or that low line there, and income portion. So as you can see, even though last year we, with our view that we expect interest rates to be low for longer and to defend the yield of the fund as they were cutting interest rates, we decided to up duration in the portfolio. So we took duration from just under 0.5 years up to 1.2, 1.3 years to try and lock in that higher yield and better returns for you as clients. Still, even with that increase in duration or volatility, most of the returns are still coming from the income portion. So capital appreciation or capital impact on the portfolio accounts to less than 5% of the overall fund. It's obviously not a money market fund and shouldn't be looked at on a daily or monthly basis because short-term returns can be quite volatile. So to draw attention to March or this time last year, where we're having similar conversations where, the client, because of the volatility and the sell-off in emerging market assets and our bonds being one of those, the fund short-term, and there were fears that, clients were, or rather clients for the rest of the year, you're going to get these low returns or even incur losses. But we kept on reiterating the message that don't look at it over a short-term period, look at it over a 1-year horizon as returns are smoother there. And as you can see from the total, the returns for 2020, or rather 1-year returns to the end of January, this fund still managed to give you a consistent return, outperforming the benchmark by 2%, which is achieves our objective of giving you an outperformance of between 1% and 2% over a rolling 3-year basis. And more importantly, given that 2020 inflation was below 4%, the portfolio gave you above or 3% above inflation for the year. And we are comfortable that even though there are, because of the volatility that Vic was talking to earlier, and there are short-term gyrations in the market, we're comfortable that for the rest of the year, we're still expecting returns around, and with inflation expected to average 4% this year, it's still going to give you similar real returns of 3% or better. Now, the flexible income fund had 0% allocation to property last year into COVID. So this, when the sector was were negatively hit or experienced losses, the fund wasn't impacted. But this year we have taken an allocation to property, and this is largely because of the punitive valuations in that sector currently. As you can see here, at some point last year, valuations in that sector implied discount to net asset value of around 50%. And our view is, unless you can argue that property values over the next few years, say 2-3 years, will decrease by 40 to 50%, this is just a short-term dislocation that will normalize. And we are no way saying that we will go back to where the sector is trading around these levels of 10% premium to NAV like before, but 40% discount at this level is just too punitive and already prices in a lot of bad news. So we expect to see further recovery in this asset class later this year as economic activity picks up and lockdowns are relaxed. We've also taken, as I mentioned earlier, we allocated into offshore bonds, and this was done through our global partner, who is Brandywine. This, like property, offers the diversification in the portfolio and reduces correlations in our portfolio, largely because of that currency leg that comes into play. I would like to draw your attention to this number here, showing that the guys at Brandywine were actually heavily underweight modified duration when we allocated into the portfolio, meaning that the global sell-off in bond yields that Victor was talking about earlier will benefit this portfolio and thereby benefit our flexible income fund. So, which is very good. And obviously entry level offshore is quite key. So this graph shows when we first allocated offshore and increased the positioning. As I said, we refined our SAA and TAA band or guidelines at the end of 2019. Beginning of last year is when we started implementing this strategy in the portfolio. But soon after, we saw the rand sell off to about 19 to the dollar, but largely traded around 17 to the dollar the latter part of last year. And we didn't allocate offshore, given that mostly for us, to lower your correlation and diversify your portfolio, you have to call your currency very well. So we waited until the rand reached what we thought was the fair value level around 15 before we first allocated offshore, and then increased it as the currency further strengthened. So this move that we've seen over the past 2-3 weeks, it's playing very well into our hands because it benefits the portfolio because of these entry levels. And this is the performance of the Brandywine Global Bond Fund, showing solid performance that over a 1-year period, they've actually given us 13% total return in dollars. Moving over now to nominal bonds. This allocation, as you can see, we've been very active in moving around modified duration over the last 3 to 5 years. And this mainly talks to that investment philosophy that I was talking about at the beginning of the presentation. So beginning of last year, we had duration similar to a money market fund, and that was largely based on our negative view on the upcoming budget. COVID happened and obviously played into our hand. At the height of the volatility or of the crisis last year, we then upped the modified duration of this portfolio to 4 years. And this year, as I said, earlier, that we cut down on bonds, and we also reduced duration because at some point we thought, 6.5 on the 5-year bond and 8.5 or 8.30 to 8.5 on the 10-year bond is our fair value levels. So it's time to rotate away from this asset class into others. So the current volatility spikes that we see now, Victor alluded to the 10-year bond yield selling off to 9.5. It actually went even closer to 9.80 yesterday. We're seeing this as opportunity to now put the cash that we had parked in money market funds or income funds to work by rotating back into nominal bonds. And pref shares. So this asset class we hadn't allocated to in years. Last year when bank shares tumbled and the regulator issued a directive that banks should suspend dividends, we saw preference share prices also getting hit, which presented us with good entry opportunities. And we allocated around the middle of August last year. So we expect this asset class to recover further into the year as banks are now resuming dividend payments. And we expect some of them to buy back pref shares because they've lost that appeal or that regulatory capital appeal that they used to carry, and they're more costly for the banks, which will lead to this asset class even recovering further. So our SAA guidelines on pref shares, it's 2.5%. We currently have a 5% allocation to the asset class. As for the fund performance, the fund had a very good year last year, which was the first year where we employed the new SAA and TAA guidelines, retaining almost 5% higher than inflation and giving you as our clients alpha of almost 3%. And we expected to return similar or to give you similar return this year, outperforming the income fund by about 1% to 1.5%, and inflation by around 4%. And in terms of asset allocation decisions that added or detracted from value here, so all asset classes except for offshore allocation added to value. Offshore allocation detracted because we took quite a while before going offshore, but that has proved to be a good decision this year. And in conclusion, I would like to, so obviously as an investor, you'd like to, in an ideal world, you'd like to be in this region where you get as much return as possible with as very low risk as you can, but that is obviously not possible. So this scatter plot shows our main funds, so STANLIB Income Fund, STANLIB Flexible Income Fund, and the Bond Fund compared to other asset classes. And first, showing the income fund that over the past year, even though this fund volatility was 1%, still gave you above 7% total returns, which was in line with other riskier asset classes that sit in the spectrum. And we still confirm we haven't upped volatility or the risk of this portfolio much, and we expect it to perform this way. And sitting now in a sweet spot is the Flexible Income Fund that for less than 2% additional risk that you're taking over and above the income fund, it still gives you even much better returns of, like I said, 1.5 outperformance compared to the income fund, and also stacks up very well with other asset classes. And obviously, with so much uncertainty out there, and the fund, we feel offers compelling returns at low risk, and we feel that you should seriously consider allocating to it outright or make it form part of your portfolio or total portfolio to diversify your portfolio. So to recap, after so many slides and graphs, what we're saying is currently cash is expensive. So to sit in cash is costly. And later this year, as inflation ticks up, you will basically go backwards. So it's time to move up the curve. And then we're also saying the current volatility or recent volatility that has been repricing fixed income assets for us presents a good entry point into our funds. And we expect income fund returns to stabilize like last year, where for the rest of the year, you probably get around 7%, 7 to 7.5% total returns, which will be about 3% higher than inflation. And as I said just now, the sweet spot in fixed income at the moment is the Flexible Income Fund because of the way it's diversified with low correlations, turning into low risk and giving you very good above money market and income fund returns. Thank you. Over to you.
I'm also on, not on off mute. Thanks very much, Sly. Thanks, Vic. And thanks to everyone for the questions. So the first question, and there's a number of people asking the question, so I think let's please just address it right up front.
Yeah.
So I'm going to pose it to you, Sly, just on the income fund. So concerns around, obviously from a fund perspective and proposition, we know that clients should be looking to invest kind of 12 months minimum in that fund, but obviously we're fully aware that many clients go into that for more short-term kind of objectives as well. And obviously when we have a kind of period of recent kind of underperformance and kind of you look at more recently kind of a negative performance over 1 month, obviously net of fees. But firstly, Sly, if you can maybe just give the audience, I know you touched briefly, but the audience just the reasons for that short-term kind of volatility on the income fund, so we can just kind of give that open, transparently to everyone. And I think importantly for all people on the call with investors in the fund, equally as importantly, what is the outlook going forward from your side on the income fund? So if you can just address those two questions, thanks.
Okay, thanks, Al. So maybe let me go back last year. Prior to these 300 basis point interest rate cuts that we saw last year, the yield in the portfolio was sitting, above 8%, closer to 9%. And that was largely because the repo rate was 6.5%, meaning the 3-month JIBAR, which most of the instruments in the portfolio are tracking, was also around that 7%. Add an average spread of 2%, or 1.5 to 2%. So that gives you the average yield of 8.5 to 9%. You cut interest rates, repo rate cut lowers by 300 basis points, sitting at 3.5%. As portfolio managers, we are faced with the decision to say, okay, how do we defend the yield in the fund to make sure that it's still compelling, doesn't deliver or give you as clients close to money market returns? We can do it a few ways. First is we can choose to say, okay, let's go and get instruments that yield big, that give you very big spreads of 300, 400 basis points to make up for that lower JIBAR rate. That means you move lower down the credit curve into single Bs, double Bs, and so forth. And that wasn't a wise decision in our view because of the economic environment that we're in. We're in a recession environment, so obviously lower rated counters will probably take a hit first, balance sheet erosion, or even outright defaults. So we shelved that. The second thing is maybe go into property because of the high yields there. As I said, the sector itself has been experiencing challenges since 2018, basically. So for the profile or the risk profile of the clients in the fund, that's not a good idea. We landed on the third option, which is up the duration of the fund, i.e. shift from your floating rate instruments while you still can and into fixed rate instruments, lock in that higher return at that level, which will then defend the yield of the fund, which is essentially what we did. We upped modified duration from 1.3 years to, or around 0.5 years to 1.3 years, locked in the yield, and then we were able to achieve that 7% total return for the fund. Now, obviously, increasing modified duration comes with a lot of volatility, i.e. modified duration is your sensitivity of how your fund reacts to market movements. Because it's now higher, it's double what it was before. Every time the market sells off, you see the volatility that we've seen in the portfolio. But we still maintain, like last year, that this is a good call. Like Victor said, we do not think the current sell-off or fears around inflation in the US and globally is a structural change. This is a transitory period, and the market will stabilize. And we're comfortable that, over the next year, the returns in the income fund, or for 2021, returns in the income fund will be no different to what the fund returned last year. Still around 3% better than inflation.
Thanks very much, Sly. Appreciate it. Thank you. I hope that answers people's questions on the Q&A. Happy to engage separately. Obviously, I've got the list of people who've posted those questions, so we'll definitely engage directly with yourselves as well post this webinar. Vic, question for you. A few questions with regards to kind of land bank. So specifically kind of our view in terms of going forward with land bank, and then obviously where we've got exposure in our funds. If you can maybe just give the audience kind of our view and update on land bank. One or two questions just with reference to, from a budget perspective, there was a sense that, from a finance perspective, not necessarily enough to bail some of the SOEs out. But if you can maybe just take that question, if you don't mind. Thank you.
Okay, yeah. Thank you for the question, Al. So I think we gave a last update to the market, on land bank last year. And the update was really around the bank together with National Treasury, working together with note holders to find a solution. They can be limited impact on the holdings that we would hold, I mean, for the bank. So where we are currently, in the engagements that we've had with the bank and National Treasury, there are three things, you know, that the bank has, together with us, I mean, they've actually been looking to find a solution on. It was really around equity injection, which the government had promised, but didn't come through, I mean, with it, which was only going to be announced at the budget that we've just had, I mean, in February. So on the positive side, the government announced a 7 billion rand injection, of which 5 billion rand is going to be made available immediately, and then 1 billion rand is going to come through over the next 2 years. And then as part of the solution to cure the default that the Land Bank suffered last year, there is what we call a liability solution, which is basically looking at restructuring the debt profile of the bank in order to make it, I mean, affordable for the bank to repay the cash flows. So where we are, we are working very closely, I mean, with the other note holders in trying to make sure that the liability solution does come through. But what it's looking like now is that the instruments that we would be holding, you know, which are not guaranteed, I mean, by the government, are going to be termed out, meaning that some of them are going to mature at a later stage, I mean, than where we initially thought. But the liability solutions intention is basically to make sure that from the collections that the Land Bank can make, the bank can basically be able to cover some of these debt obligations, you know, that they have. So there's a lot of private information that we as investors on behalf of our clients are working with, which sometimes it makes it very difficult maybe to give a complete picture, you know, to the market, given that I mean, the instruments that are already also suspended, I mean, on the Johannesburg Stock Exchange up until, I mean, such time that this information becomes available. But what I think is important, I mean, to answer you is that STANLIB, as one of the influential fixed income managers in the markets, we're working very closely with the bank in trying to find a solution, and we will keep, I mean, on updating you as much, I mean, as possible as this information becomes publicly available. So, of course, I mean, from a valuation point of view, spreads had blown out last year as a result of the default that we have seen, something which is also, I mean, already reflected in our portfolios, with the instruments now being delisted from the exchange. We've got a valuation committee, you know, that that basically, I mean, looks at where fair value for these instruments would be.
Thanks, Vic. Appreciate that. Thanks very much.
And then I think there was a second question.
So the second question is just more broad-based on SOEs in general, Vic. So obviously specific to Land Bank.
Yeah, so it's a challenging environment for SOEs in general. I mean, given that some of them are largely dependent on the government, which basically could also have implications. I mean, the fiscal slump, like we have seen, I mean, the government basically having to make payments on behalf of Eskom. So with the way that the Land Bank defaulted and the way that the situation evolved, you know, over time, I mean, there's no doubt in my mind that the way that markets would have looked, I mean, at SOEs in the past and maybe currently is going to be different, you know, in future, which means there's certainly going to be some premium that investors like ourselves, I mean, would demand, I mean, before we invest in instruments like this. And certainly, I mean, at STANLIB, I mean, for the investments that we have on the portfolio, there's a lot of due diligence work, I mean, that our credit team has done together with the credit committees. and we are comfortable, I mean, with the exposures, that we have in the portfolios. But suffice to say, for the government, it does become a bit worried for them, because it can make it a bit difficult for some of these SOEs to basically come into the market and borrow at the same rates that they did.
Okay, thanks, Mikkel. I mean, obviously, you and your team consistently keeping, obviously with the credit team, with Taryn and the team, obviously on top of all of that from an SAE perspective.
Yes, so I mean, so it's a continuous monitoring like we do with, I mean, every other credit, but for the SOEs, even much more so. I mean, given that some of them, I mean, are struggling. So our credit team, I mean, we meet on a bi-weekly, I mean, twice a month to I mean, the different exposures that we have on our portfolios. And certainly, I mean, from an investment point of view, we've been very selective. I mean, in the SOEs that we put on our portfolios, staying away, I mean, from some of the ones that are obviously are not palatable. Maybe if I can just give you an example, like your Janelle, for example, and then we've got, I mean, other exposure.
Sorry, Vic, you said like a what?
No, okay, I'm saying like there are other SOEs that are basically not doing, quite well. I mean, that we have actually avoided to invest in them. And of course, I know maybe one of the questions that most people would have is our exposure to ESCOM. So that exposure that we have in our income fund is all totally guaranteed by the full faith of the government, meaning that if anything goes wrong, I mean, we would go and claim those I mean, obligations from the government. Of course, I mean, those instruments are coming from authority, and they have actually, I mean, benefited the portfolio, given that we bought them at 275 basis points compared to where they subsequently traded. But we are coming to a space where we are going to be making a call as to whether we're going to be rolling these investments. But I don't want to preempt, I mean, the decisions of the credit team together with the credit committee. But it's going to be taken to the committee, and then yeah, once the decision is made, then that will be reflected on the funds.
Okay, perfect. Thanks very much, Vic. Sly or Vic, I mean, this question comes from Dwayne Cole. Just obviously with rising concerns around inflation risks, obviously globally, the question is, should developed markets raise their interest rates to keep inflation contained? That's the question. And then if that was so, what would the potential impact be on the SA bond market, and obviously potentially knock-on effect onto our portfolios? So it's a two-question question. Sly, do you want to take it?
Yeah, I'll take it. Thanks, Al.
Perfect.
So I think the question what we must be clear on is why would a central bank raise interest rates? They raise interest rates to cool down the economy, i.e. if economic activity picks up to an extent that prices are increasing out of control or rapidly, that's when they come in to raise interest rates to cool down the market. Now, bring it down to or back to the South African environment, where there has been a lot of job losses. Unemployment is at the highest point ever, and economic growth, like we saw in today's GDP print, the economy contracted by 7% last year, and is only expected to go back to 2019 levels in 2023. Now, why would a Reserve Bank raise interest rates in that environment? There's just a whole lot of, people lost jobs, and some of them took salary cuts, meaning disposable incomes are under pressure. They can't spend. And we're seeing it in retail sales, in all sorts of economic data. And even though, like we said, we expect inflation to tick higher to about 5% this year on a monthly basis, but in total, average for 2021 will be 4%. In 2022 and 2023, the Reserve Bank themselves are expecting inflation to be below the midpoint of the target band, which is 4.5%. So in an environment like that, even though we see because of transitory factors in the US and their fears of inflation globally, we do not foresee the Reserve Bank locally having to hike interest rates. And important to note, the taper tantrum that Victor was speaking to or alluded to in his presentation of 2013, that happened why then Reserve Bank had to hike rates to try and defend their currencies is because the current account deficits then for emerging markets like ourselves were in big deficits. Economic growth was actually quite robust, even locally, and the rand was very strong. So as that sell-off happened from the taper tantrum, obviously because current account deficits or current accounts are in deficit, meaning you rely on inflows to finance your accounts, they had to hike rates to make the rand more attractive for foreign investors to bring in their inflows. Contrasted to now, where the situation is basically the opposite. We're in recession, we're running a big current account surpluses, largely because of the very favorable terms of trades, and your currency is very weak. Why hike when there are no structural inflationary pressures now? So we don't foresee the Reserve Bank hiking interest rates until at least the back end of next year. And even when they do that, it's going to be a very slow process.
Okay. Thanks, Lai. Appreciate it. I think we've got time for one more question, and I'm going to just pose it. There have been a few questions with regards to the Flexible Income Fund. So, Sly, probably back at you. Sorry, Vic. But just in terms of, there's a question specifically related to property. So just the 3.5% exposure to property, you know, what, if you can just maybe get a little bit more detail of what sector, et cetera, that's in. And then the other question that's come through is, you know, we position the Flexible Income Fund as an alternative to consider in terms of clients looking for, you know, potential higher return or meet income requirements. And obviously it comes with a little bit more risk that we're used to compared to an income fund money market. So how do you guys kind of manage the risk in that portfolio to ensure that from a risk adjusted return, it's still an extremely competitive offering to clients or to be considered for clients?
Okay, so the first question is we allocate directly into Keelan's team's Global Property Fund, and they manage it on our behalf. So we don't do stock allocation. We allocate it at an asset class level, and without a further cost for clients, the property team will run with that allocation. And in terms of managing the risk in the portfolio, as I said, so it's largely based on diversifying the portfolio as much as possible so that the correlations of the different asset classes that you've allocated to are very low. So for instance, I can use offshore allocation, or even without looking at a particular asset class, let's look at the currency. Why I'm saying the low correlations then will lead to lower risk is if the portfolio is invested in bonds locally and some currency, so we've bought dollars, we're sitting on offshore cash. If bonds sell off, or in an environment like we are now, where we're seeing a lot of volatility and they sell off in bonds and currencies sell off. So because the bond sell-off leads to negative valuations on the portfolio, that is negated or balanced by the weaker rand will mean better returns for the portfolio. So overall, that contains the risk in the portfolio. So by diversifying away or diversifying as much as possible and lowering those correlations, and property is also one of those asset classes that if you look 4 years ago, you couldn't get that diversification benefit because bond yields were highly correlated to property yields. So it was a yield play. But now, because most of the sector is offshore and there were structural issues within the sector, those correlations are very low, meaning an allocation to property, like we are seeing now, actually can be a good diversifier and lower correlation for the portfolio.
Okay, thanks very much, Sylvester. Thanks, Sylvester and Vic. I really appreciate it. Appreciate your time and the insights. To all those who have attended, I hope you've enjoyed this afternoon. We've tried to address some of the more difficult and questions that have come through, and I hope we have managed to do that. On behalf of the team, I'd like to say thanks for joining us. The next webinar will be in 2 weeks' time, so please look out for that invite. It will be with our index investments team. But yeah, once again, on behalf of the team, thanks very much for joining us, and have a good afternoon. We'll chat in a few weeks' time. Thanks very much.